Chinese property sector stocks finally rallied on Tuesday on reports of a plan that could help firms raise capital, which will ultimately be guaranteed by the state. During past 2 years, the successive defaults in Chinese real estate high-yield bonds, starting from Chinese Evergrande Group, caused a series of chain effects, where real estate companies running out of money with no alternative financing channels available, and COVID-19 causing sales to freeze, and the vicious cycle continues. We once thought the music will never stop and the game will forever continue, but now it does not seem like the case. There are two types of real estate companies in China, state-owned and privately held. Among those state-owned companies, the high-yield bond default ratio is very low, almost to zero. And the relatively healthy financial performance can be attributed to two major reasons. First, they're less aggressive in terms of leverage. And second, state-owned real estate companies usually have group-level guarantee, which enhances investors' confidence. On top of these two reasons, they're also naturally deemed as safer assets as they're closer to commercial banks for funding purposes. Privately owned real estate companies are not that lucky. High-yield bond of quality real estate names including Longfor, Vanke, Country Garden were dumped by investors despite company fundamentals. Other more problematic companies are on the verge of bankruptcy or at least trying very hard to sell assets or equity stakes to survive. As of today, Shimao's US-denominated high-yield bond is trading at 10 cents on the dollar, and its yuan-denominated bonds are also trading at a steep discount. Are all these avoidable at all? I've been speaking to many economists and policymakers recently, and the answer is probably not. These are the so-called accumulated debt that need to be paid back to the system. Housing prices cannot go up forever, and whenever economy slows down with decreasing investors' appetite and government no longer supporting more funding as skyrocketing prices induces inequality, the whole system corrects. According to Professor Xu Chenggang, the total value of the real estate in China is now 4 to 5 times of GDP, which is never seen elsewhere in the world before. When Professor Zhu Ning's word, this guaranteed bubble will not last forever. Well, the current situation is the transaction volumes are low and also the liquidity is drained to historical lows. According to statistics from Goldman Sachs and Crick, the year-to-date primary GFA sold on average dropped 46% year-on-year, and secondary GFA sold declined 23% year-on-year. So what is the next? In my view, two Chinese private companies are setting very good examples. Central China Real Estate Group sold majority control to state-owned companies and paid back their high-yield bond on time. Investors' confidence was boosted, and the company may also survive with this new funding source. The other company, Longfor, is fighting against the capital markets bias by issuing primary shares to international investors with the backing of state-owned companies' guarantee. And most importantly, both companies are demonstrating their determination to survive. In my view, the old over-leveraged expansion model in China real estate sector is obsolete. However, those quality names shall survive. After all, we all need those quality developers to make our everyday life better.